The markets have pushed to new highs this year, but some investors continue to question the health of this rally. Joining us now to discuss and what he's seeing out there, and of course he brings the charts, Ben Gossack, Managing Director and Portfolio Manager with TD Asset Management. Great to have you back on the program.
Thanks. I feel like it's been a while, but glad to be here. Lots going on and happy to talk markets with you, Greg.
I think it's been a while because you've been out in the real world talking to investors, and you were telling us when we were chatting about heading into this show about the fact that we've seen this rally, we've seen these new highs, and there's still skeptics out there in terms of like the popular myths that persist as to what is going on out there. What myth do you want to begin with?
Yeah, so definitely fall, very busy season, but a great opportunity to touch base with clients and unit holders of our funds. And I also find it's great to kind of hear the questions that we've been receiving. So you have a market that's trading at, let's just say, near its all-time highs. and the first question is, how can this go longer? Should we become defensive? When can I get my pullback? So yeah, I thought, in order to know where we're going, sometimes you have to know where you came from. So I thought we'd put together a chart just talking about the journey that we've been through. A lot of the questions I still get, Greg, is, are we heading for a soft landing? Are we heading for a hard landing? I think for the equity markets, I thought this was resolved in 2022. So if we pull up our chart, this is just looking at the price index for the S&P 500. It took 200 days for us to go from the peak in 2021 to the bottom in 2022. That was a 28% drawdown. I would argue to you, Greg, that this was the equity market deciding that we were worried about a hard landing. And I'd say the absence of a hard landing is the reason why we've been rallying.
So the market sort of figured that out way back. It looks like about December or November of 22 when it started coming off the bottom. People look at that graph and they say, well, sure, the line goes, up and to the left, but it's just a handful of artificial intelligence stocks, the Magnificent Seven. What do you say to that?
And I know you want me to agree with you.
That's not me. That's what I hear on the street sometimes.
I know you want me to say it's all been 7 stocks. And so we can't discount the fact that we've had very large companies that have been tied to this artificial intelligence trade appreciate higher. Absolutely sure that is factually correct. But because they're so large, it tends to get other stuff that's happening in the market, you tend to get distracted or it gets unnoticed. So one way that we like to look at things, again, we talk about it being like a tug of war. We like to look at one asset class or one sector versus another sector. We think this is good hygiene. This helps us to ask really good fundamental questions and then do the research to understand why this is happening. So why do we think this has been healthy? Well, let's look at one lens. One way you can look at sort of, is it offensive versus defensive, bullish versus bearish? Let's look at the actual consumer. Because last time I checked, I think the consumer drove 70% of the US economy.
Yeah, pretty much, yeah.
So what we're looking at here, those that are familiar with my charts, we like to look at ratios. So we'll take the price of one stock or an asset class and we'll divide it by the other one. The reason why we prefer these ratios is we're not dependent on any start date in our analysis. What they're looking at right now is equal weight consumer discretionary divided by equal weight consumer staples. The reason why we focused on equal weight is because if you just look at consumer discretionary in the US by market cap, it is extremely dominated by 2 companies. That's Tesla and Amazon. And so you're not really seeing the effect of the other companies. And so I think you can see from this chart, Greg, starting somewhere around 2022, circa summer, there has been a clear signal that the wants have outweighed the needs. And so yes, people ask questions about, we know the consumer has spent their surplus savings from the pandemic. There are lots of surveys that say, some consumers are finding it tough in this interest rate environment. But that chart tells me that things have been pretty good in terms of consumer spending, for what they just want on a discretionary basis versus what they need on an everyday basis.
Right, the wants versus needs, very interesting chart there. What's the next picture you got for us, and what is it telling us?
Yeah, so again, we don't challenge people to say that AI has helped to drive this rally, but where we really push back on is to say, we actually think that this has been more of an industrial-led bull market. We have shown this chart before in previous shows, Greg. This is equal weight US industrials over equal weight S&P 500. Also, similar signature, picks up in the summer of 2022 and has been a consistent signal. I've gotten lots of questions, what about mid caps? What about small caps? And we've talked about this, mid cap, small cap industrials have also excelled. People talk about, well, what's happening in international markets? And it's okay. International industrials, whether they're in Europe or Japan, have also done very well. And a lot of that being driven by people, adjusting their supply chains, given the pandemic, given concerns over China. We've seen Infrastructure Act bills created, CHIP Act bills. And yes, there is also some AI data center demand also driving these companies as well. But how can you look at this chart and then say, I think it's only been 7 stocks driving this market?
All right, so we've done the consumers, we've done the industrials. What's the next picture and what is it telling us?
Yeah, so the next thing that we're looking at is financial. So, again, going back to the questions of being offensive, defensive, cyclical, if you look at equal weight financials in the US divided by equal weight S&P 500, around, I'd say even before the Federal Reserve told us that they're going from a hiking phase to a cutting phase, I think that was around November of last year, you can already see that the equal weight financials are starting to lift off. Now, if you were just to look at large cap US banks, you'd say, other than JP Morgan, they've been kind of lackluster. Regional banks as well. The reason why we favored this equal weight over equal weight is helped us to see that let's say the alternative lenders, so be it private equity, has done really well. The insurers have done really well. And so again, we do have this large cap issue at the broader index level. It also creates issues at the industry levels, and so people aren't able to see the true signals that are happening within the market.
Okay, do we got any more pictures? I know you always bring a lot of charts. I don't want to cut you off. Yeah, we got another one here?
One more chart. Again, okay, we're at all-time highs in the market. Does that mean we need to get defensive? Well, let's look at what defensive is. This is equal weight consumer staples divided by equal weight S&P 500. Again, it's almost the inverse of what we saw with the financials. Around early 2023, staples, again, on an equal weight basis, so adjusting for market cap, have just steadily declined. That's not a chart that says, oh my gosh, let's get defensive just because the S&P 500 is breaking out to new highs.
Some people, I guess, when they think about getting defensive, we have some risk events on the horizon. One is drawing very near. It would be the U.S. election. How should investors be thinking about that?
So I don't think they should be thinking about that. I do think, I think everyone should be following an investment process. We've talked many times, you don't have to listen to my process, but definitely follow an investment process or work with a professional to develop an investment process. If your investment process is so sensitive to an election, then I would go back and say, let's go over this investment process. I can say for our investment process, we haven't had to make adjustments for the election. And the only reasons why we would make adjustments to our portfolios is if the rules have changed given this administration. We have seen people try to front run elections given some of the chatter about what these rules will be. And I think we've all, it's been litigated, I've seen it many times, about how we thought this administration would be the clean energy administration. And it's those particular stocks over the last 4 years that have disappointed the most. Versus other areas where we thought this administration would be tougher on. So whatever you do, if you are worried about the election, there's an opportunity to review your investment process and understand that this really shouldn't cause you to turn over your portfolio.